We appreciate all of the guests who have appeared on our show and sincerely thank them for providing you, our audience, with useful information. However, the advice our guests provide is theirs, and we encourage you to seek out a professional if you have specific questions about any topic we cover on the Crushing Debt podcast. On this week's episode of the podcast, Entrepreneurship and Credit Scores.
Welcome to the Crushing Debt Podcast with your host, Florida attorney Sean Yesner, where our goal is to help you get rid of the financial bullies in your life.
So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner, owner and founder of Yesner Law, and I have another guest for you this week. However, before we get to my guest real quick, I want to talk about our editor, Mark Purvis. Those of you that have been listening the last few weeks know that Mark is an Emmy Award-winning videographer with over 23 years of marketing and advertising experience. His newest passion is working with families, helping seniors record their life stories using fun and creative storytelling techniques. He would love to work with a working professional who wants their retired parents to record their life stories so that the family can enjoy meaningful conversations sparked from watching all of these videos together. My editor is a gentleman named Mark Purvis, and the website you can go to see how to record those conversations is legacyspotlight.com. So thank you, Mark. Mark's been with us since the beginning of the show. He's been the editor since the beginning of the show, but just recently we wanted to highlight him and his new project here as a sponsor of the show. So I do want to get to my guest here real quick, so let me introduce him to all of you. He is a California mortgage broker and real estate broker. He's been a real estate and mortgage professional since 2005. He has seen the world of real estate from all angles, commercial, residential, and capital raising. He has a background not only in real estate and finance, but also in infomercials and creating a $1 million real estate enterprise through the Home Shopping Network. He is the co-owner of a boutique mortgage brokerage that specializes in self-employed borrowers, something near and dear to my heart, including artists, business owners, and creative entrepreneurs. A lifelong student of economics, he also provides practical information about money and finance. He has an upcoming book that I'd like to talk to him about titled Money, What It Is, How It Works, and How You Can Use It to Create Wealth and Prosperity for Yourself and Your Community. He teaches the fundamentals of money and wealth, which is what we're going to talk to him about today. So welcome my guest, Alejandro Szita. Welcome, Alejandro.
Thank you, Sean. It's a pleasure to be here, and thank you so much for inviting me to your show.
Yeah, thank you. I appreciate you being on the show. So I wanted to talk to you sort of real quick. What intrigued me about talking to you is that, you know, I've been on my own as an attorney now since 2004, and my law firm, Yesner Law, is actually this year is its 10-year anniversary, which I'm going to talk about as we get into the coming months. But I started.
Congratulations!
Thank you. I started Yesner Law in September of 2012, so now September of 2022 will be 10 years. Luckily, at the time I bought my house and at the time I refinanced my house, I had owned a previous law firm, but that law firm was, I want to say 6 or 7 years old at the time that I bought my current house and financed my current house. You know, back in 2012 when I started this law firm, I knew better than trying to refinance. I don't know that I would have gotten a loan with no history. So why is it so difficult for someone who is self-employed, someone who works for themselves? Why is it so difficult for them to get a mortgage?
Because the system is not geared to self-employed or independent people. The system is geared to W-2 employees who work for a company. This wasn't the case before, you know, in the 50s, in the 60s, in the 70s, which is what I experienced when I was growing up in my country of Chile. You would go to your bank, you would have an account executive, he would know you, he would know where you worked, he would know about your lifestyle, he would know who your friends were. You went to talk to him, he will punch a couple of keystrokes on his machine, and then he'll see what is your balance, you know. So when you came to him and I said, hey, you know, I want to buy a house, he'll know exactly what you needed. However, that system was discarded for a more massive, more impersonal, and a more faster system, which is the system we have today, which is risk, quote unquote, risk driven. That's how they, when I say they, I mean the people that created this, refer to it. This system has worked very well because it has allowed about 90% of applicants, which is the W-2 employees, to get a fast, cheap, and reasonably priced I would say, very low-priced loan. However, it's pretty much the direct opposite of the system that existed before. And therefore, anyone that doesn't fit the specific guidelines, it just falls through the cracks. And I made it my mission to cater to those people, to the people that, quote unquote, fall through the cracks.
What are some of those guidelines that the traditional lender looks for? How does the self-employed person fall through the cracks?
Well, one of the things is income. The traditional self-employed person or the business person works on cash flow. He has a variable cash flow. Sometimes he gets a windfall. Sometimes the cash flow is low. So he's thinking about cash flow. He's not necessarily thinking about profits. He's not necessarily thinking about monthly income. So the typical self-employed or entrepreneur or business owner would have a really good month. In that month, he would pay all of his bills. And then when the pickings are sort of slim, he would allocate his cash flow in terms of priorities for him and for his business. So I'll give you an example. Let's say he has a bill. And let's say he can't pay the bill. He has the money to pay the bill. But there is something else he can do with the money. He could pay an employee. He could borrow something. He could buy equipment. He could spend it on advertising. So he would think, okay, if I'm late on this bill, maybe I'll pay $100, $200 fee. But to him, that's just cost of the money. He doesn't care. He knows he's going to pay it, but he prioritizes his cash flow in a different manner. That is the antithesis and the enemy of the system we have today. The system we have today was created by the bondholders. And then stop me if you feel that I'm going a little bit off topic, but this is what is happening. You always hear, pay your bills on time, you'll have good credit, you'll qualify for a loan. But that's just half of the story. They're not talking about bills. They are talking about contracts that you sign with an institutional financing company. They're talking about credit cards. They're talking about mortgages. They're talking about car loans. They're not talking about your rent. They're not talking about your electricity bill. They're not talking about the money that you owe and you're paying to your business partners. It's a very specific, narrow range of institutional financing that they are talking about. And they want you to pay this bill like a bondholder, like a clock, on time. So that is the enemy of the self-employed, is the enemy of the entrepreneur. I can tell you, I know many, many entrepreneurs, and usually a good entrepreneur is not a good CPA. He knows about money. He knows about the cash flow. He's controlling the cash flow. He's making money, but he's not the guy that is going to pay all your bills, quote unquote, on time, on all the institutional bills on time. And boom, then he gets a big strike against him because of that. Another thing is the variable cash flow. A regular lender doesn't understand a regular cash flow. A regular lender is looking for a fixed monthly payment. And an entrepreneur is not like that. He could have a month where he made 100,000, and he could have another month where he lost 50,000. That throws the regular lender off completely. He doesn't know what to do. Then the regular lender goes and says, well, show me your tax returns. And the entrepreneur is going to want to minimize his tax returns. Like, I know a client who's a lawyer, like you.
Right. He
grosses $2 million a year, but his profit is 50,000. That's, of course, is an extreme. But just to let you know the difference, a W-2 employee doesn't have a lot of control over their tax, over his or her taxes, but an entrepreneur or a business owner does have control. So when a regular lender tries to evaluate the credit worthiness of the entrepreneur, everything is the opposite. Credit score is the opposite. Cash flow management is the opposite. Income is the opposite. The documentation he's asking for, like tax returns, is like a non-relevant documentation. However, that is the documentation that is needed. So you have these two universes that collide. You have the self-employed person that makes good money, has a good business. He considers himself creditworthy. He has a relationship with the bank for, let's say, 20 years. This actually happened to one of my clients. He thinks, I'm going to buy this house, which to him is cheap. He could pay cash, but because he's an expert at managing cash flow, he recognizes that maybe paying cash is not the best. Maybe he gets a loan that he can pay. He goes to the bank and says, hey, you've known me for 20 years. I just want to buy this cheap home. Loan me some money. And this happens every single time. He's shocked and flabbergasted when the lender talks to him. He's a poor guy that cannot even afford the cheap house that he wants to buy, that his credit is bad, that his income is shifty, and therefore, I'm sorry, but no, that is a shock. And it's a shock that sometimes they never recover from.
Yeah, no, I've seen that a lot of times too, and I mean even for myself. In other words, I have the law firm, but at a previous point in time, I also owned a title company, and I've since shut down the title company, and I now represent some title companies in the area. But I remember when we shut the title company down, it had a massive, massive loss, and to me, I'm thinking this is fantastic. I've got this loss that I can carry into future years to reduce my taxable income and reduce my tax burden and maybe even get a bigger refund, whatever. But when I went to qualify for a loan to refi the house, the lender said, wait a minute, you've got this other company here that's got massive losses. And well, yeah, but that company's been gone for 3 years and I'm just carrying the losses forward every year. But still, they didn't want to see that I was part of something that was such a big loss.
Correct.
It was weird. I mean, and I could, like you said, I mean, so the law firm, I get a W-2 from the law firm, and then at the end of the month, if there's any profits, I get to take some of the profits as well from the law firm. And you're right. There's those months where I go home and, hey, we're all going out for a big steak dinner. And then there's other months that I come home and I say, I don't care if the bread is moldy. We're still going to eat it because we can't buy any more right now. So I totally get it. But it is strange in that, wait a minute, I've got this law firm that's showing these profits for 3 years. I got this little company that I shut down 3 years ago that's showing a loss. And now you're not going to give me a loan because of it. It was the strangest thing.
Yes.
So what types of real estate loans are available to the self-employed business owner?
There are many. I can tell you that I know at least there are 7 other ways, apart from the tax return system, to qualify a borrower. You can qualify someone using their bank statements because remember, the self-employed or entrepreneur has cash flow. So instead of looking at their taxes, you look at the cash flow and you do that through the bank statement. So there are programs where you need to show 1 year of bank statements, programs where you have to show 2 years of bank statements. And the beauty of this is that it could be any bank statement. It could be your business, personal, a mixture of your business and personal, and the more bank statements you can show, it doesn't have to be only from one account. It could be from 2, 3, 4 accounts. We've had like 100 bank statements once working for a client. So you have the bank statement universe. That I call it a universe because it's not just one thing. You have like 5 or 6 ways of doing it within the bank statement universe. Then you have entrepreneurs that have saved a lot of money and they quote unquote don't work in the sense that they don't go to work like you and I, but they have investments that they manage. So for those type of entrepreneurs, there are like 2 or 3 programs that take a look at the income that he derives from the investments only. He doesn't have to show that he works anywhere. He doesn't have to show any W-2s or anything. All he has to show is that he owns the investments and the proceeds from the investments are enough to pay for the mortgage. And then for the business owner that has a profitable business, you can show profit and losses, a profit and loss statement that doesn't have to be audited to sustain his or her income. Because at the end of the day, all the lender wants to know is, do you make enough money to pay the monthly payment? And do we see that you've made it in the past for at least 2 to 5 years? And can we see that in the future you're going to continue to make the income? That's the number one criteria to make the loan.
So are you trying to say that it's more difficult to get a mortgage when you're self-employed?
Yes, very much so.
Yeah, because of the way the system is set up, because of what people want to, what the bankers want to see.
Right. And the system is not going to change because the system, from the point of view of the banker, is very successful. You can get 90% of the people, boom, in a very inexpensive way for the banker.
Okay.
So it's not going to change.
So if I wanted to go the traditional route as a self-employed, so let's say I bump up my W-2 salary to show a more robust, more consistent. I know there's tax reasons not to do that, but let's say I did. And then the next thing I worried about is my credit score. What are some things I can do to maybe improve or increase my credit score?
I'm going to tell you, but this information doesn't come from me. It comes from a loan officer by the name of Philip Tyrone. And by the way, I'm not affiliated with him. I don't get anything from him. It's just that I've seen many systems. I've tried them on myself, and this is the only one that works. Philip Tyrone created a system back at the beginning of the year 2000, where he really describes how the credit scores work. He has, you can go to eBay, you can download, or you can purchase he has 6 CDs where he explains it all. So I'm going to try to summarize it, but again, this does not come from me. Basically, the key for the credit score is to have the credit and not use it. When I say not use it, it means that if you get a $5,000 credit card, don't use more than $500. You have to have 3 credit cards. You have to have 1 installment loan that could be a car. And that is the ideal combination, those 4 trade lines, 3 credit cards that you don't use, meaning that you don't charge more than 10% ever. And then 1 installment loan that could be a car, or if you already have a car, just go to a credit union and refinance it. You don't care how much they give you. Just park it on a savings account, have it for at least 2 years. And then you have an awesome credit score. I'm going to tell you a little story that to me was like incredible. I had this entrepreneur guy, millionaire, millions of dollars in the bank account. You looked at the credit report, 40 paid mortgages, 40 paid mortgages. Credit score barely touching 680. Next to him, you have this young girl, maybe 2 or 3 years credit score, 2 credit cards that she barely used. Yeah, 800 and something.
Wow.
Credit score. And this is the interesting thing. When you submit the file to the lender, you have the option to write a letter. You have the option of explaining what you're doing. So I explained it to them. Look, this guy has 40 paid mortgages, 40. However, the system is so like a machine, they didn't listen to it. They would prefer the girl that has 2 or 3 years credit history and has 800 than the guy that has 40 paid mortgages all day long.
Wow. That just doesn't seem right. It doesn't seem fair.
I know, and that's why that led me thinking, okay, this system then is not geared to assess, how good or how bad you are in paying your bills. This is a very specific criteria. It's the criteria invented by bondholders to see who is the most likely that they can make money on. It's completely the reverse. It's not you being a good person. It's not you being responsible or successful. No. It's a system invented by bondholders to see who they can extract the most money and make the most money. And that criteria of person is a person who has credit, barely uses it, always pays it, and has a combination of like 3 or 4 credit card, 1 installment loan, maybe a mortgage. That's the person that they're looking for, not because that person is responsible, not because that person is successful, not because there is any quality, any moral or value associated with that. It's only because they can make more money on that person. That's the only criteria. And that's what surprised me.
Yeah. Well, and it's interesting because the other side of my practice is bankruptcy and helping people get out of debt, which is the subject of the podcast. And the interesting thing, someone will be being sued by their credit card company or whatever, and we decide that bankruptcy is the best idea for them. And they always say, well, won't that hurt my credit score? Well, number one, your credit score is already getting beat up because you've got these lawsuits and you've got these unpaid bills and you've got whatever. But what I've always said, which sounds like you're sort of confirming, what I've always said to them is, look, when you file your bankruptcy and you get your discharge, especially if it's Chapter 7, the bankruptcy code says you can't file again for 8 years. And the creditors know this. And so I've had clients that have gotten credit cards weeks after their bankruptcy is over because the creditors know they've got them on the hook for at least another 8 years if they charge up those cards, which would seem to go towards your point of, they just filed a bankruptcy, but I can make a ton of money as the credit card company off of this person if they run up the bill and they can't pay it again.
Yes, and you mentioned something so crucial. Do you know what the rule of 72 is?
Yeah, how long it takes your money to double based on a certain interest rate.
Exactly. How much is 72 divided by 20?
72 divided by 20. Yeah. I didn't know you were going to make me do math on this show.
So it's about 3.
It's
3 something.
Between 3 and 4.
If a credit card charges you 20%, in about 3 years, they double their money. So that means that if you borrow $100, 3 years from now, and you don't pay it, which a lot of people don't, 3 years from now, they're going to recover the money and make it again. So they're going to recover the $100 and make another. So let's say that you take a credit card, like you were saying, for 8 years, because you cannot file for bankruptcy within 8 years. What do you think will happen to the profit of the financial institution within those 8 years?
It'll double at least twice.
Yes. So they make a shitload of money. Sorry, your editor is going to cut that out. They make a bandload of money. Okay. Now, imagine that you default by year 4 or year 5. These guys already have made a bundle.
Right.
In my previous life, I was in advertising, like you read, the Home Shopping Network, and I used to do infomercials. And I made an infomercial for a debt negotiation company. I saw the records of 8,000 people, and this is what moved me. People, even on their deathbed, they were trying to pay their debts. You see, people have a moral code and value that the counterparty does not have at all or cares. So people on their deathbed were trying to pay the credit card company, even if they could not pay them completely. So imagine, in a few years, you more than double your money. You made a bond load. Then the person defaults. But even when they default, they still pay more. They still try to settle their debt. So by the time the person is defaulted and paid, the credit card company already made a bundle.
Right.
So of course they want you back.
Right. And of course, you're right. I mean, that's the other big objection that I get when I talk about bankruptcy with people is I borrowed the money, I should pay it back. And I say, well, I understand that and I agree with that. And it's certainly a very noble position to take. But Visa's not going to go out of business because they don't get your 10 grand back. Or more to your point, they've already got their not only have they already got their 10 grand back, but they've got it back 2, 3, 4, 5 times over. So to file bankruptcy to get rid of a debt. And again, certainly I'm not suggesting that bankruptcy is always the right alternative. I've told people before bankruptcy would be a bad idea for them for one reason or another. But for the people that have that mental block of, I borrowed the money, I should pay it back. Well, depending on how long ago you borrowed the money, you've already paid it back plus.
Yeah, and like I agree with you, it's not a matter of trying to rig the system and going, well, if these guys want to take advantage of me, now I'm going to take advantage of them, because then that's a losing proposition that is not going to benefit anyone. But if you find yourself in that situation, then you need to evaluate, what's going on the other side. And of course, it's better not to get into that scenario to begin with.
We talked about the different types of real estate loans that are available to business owners. As a business owner, is it better for me to try to raise my score and just qualify for a traditional business loan, have my W-2s and all that kind of stuff? Or is it better to go the other route and base my loan on bank statements, profit and loss statements, cash flow statements? Should I try to conform to the system or should I go the other route?
That's a very good question. And the answer is very personal. What I've seen is some people are very close to the traditional route in their affairs. So when I see that, I try to help them move to the traditional route in order to qualify. It usually takes between 1 and 2 months for most people to qualify that way. Now, if you are very, very far apart, like the other attorney that I was telling you makes $2 million, says he makes 50, the gap is so big that there is no way even thinking about that. Now, the difference between the traditional and the alternative is about 0.5%. So that means, just to throw a number, if you could have gotten a 5% loan traditionally, the other side is about 5.5. So the difference is not that great, but if you're not that far away, I would rather push you to the traditional guidelines so you can get a better deal.
Okay. And that brings up another question is, what do I look out for in order to know if I've got a good mortgage? And let me sort of preface that too with, you mentioned it goes up 0.5% if you do a different type of loan. I've always been of the opinion that you don't so much focus on the percentage, the interest rate. And that's what a lot of people today, especially I heard this morning, I don't know what you're seeing, but I've heard this morning that rates are now inching into the 6% range where they used to be at 4%. But, if I said to you, I'll give you a 6% loan and your payments are going to be $1,000, or you can borrow twice as much at 4%, but your payments are going to be $1,800. Well, I'd sort of much rather have the lower payment, even if it's a slightly higher interest rate.
It's not about the rate. It's never about the rate. It's
right.
about what you're trying to achieve.
Right.
What you're trying to achieve doesn't necessarily mean the lowest rate. And another thing is this. You hear, like you just said to me, you hear on the radio, you look on TV, or the rate is blah. That rate, almost no one can get it, by the way. That's just a number being thrown out. Why? Because the rate depends on your credit score, depends on the type of property you're buying, depends if you're going to live in it or not, depends on how much money you're putting down, depends on whether you're a W-2 employee or going bank statements, and there are like 5 or 6 other criteria. So by the time that I looked at your scenario, you're going to qualify for a specific rate that maybe your next door neighbor will not be able to get, or vice versa. So it's not about the rate. It's about what you're planning to achieve. A quick example. I'm quoting a mortgage for this couple that they want to buy a house and using for investment purposes. They went to a credit union, and credit union will always give you the best deal in terms of costs and fees. So if you want to save money on rates, become a member of a credit union. And for most people that just want to buy a house to live in it as a primary residence, the credit union will always be the best alternative. But once you move from that universe a little and you start to get into the business side of it, that changes because credit unions don't cater to business people. They cater to people that want to buy their primary residence. And then what matters is the deal. Maybe you need to pay more points. Maybe you need to pay a higher rate, but maybe the type of loan that you're getting allows you to get what you're looking for. So it's not about the rate. It's about your purpose. It's about your objective. I don't know if that answers your question.
No, I think it does. And I agree with you. And that's sort of how I tried to set it up, is that people that are focusing on interest rate, and I get it, a lower interest rate means lower payments in most cases, but people that are focused on interest rate may be focused on the wrong thing. Focus on, is the payment affordable? Focus on, is the house affordable? If you qualify for a $400,000 loan, that doesn't mean you want to get a $450,000 house and put 50 grand down. Why not get a $300,000 house and put 50 grand down and put another 100 grand into improvements or whatever? So I completely agree, is that interest rate isn't the only thing. But is there anything else that a borrower should be looking out for to avoid a, quote, bad mortgage?
I wouldn't call them bad mortgage. I would call them undisclosed mortgages. You see, I come from a real estate background and I did a lot of real estate. And in real estate, you have this rule: disclose, disclose, disclose. When I got into the mortgage business back in 2006, it was worse than it is today. People in the mortgage business do not want to disclose. They don't want to tell people how much a loan really costs, because to originate a loan is expensive. Even in Florida, where you can buy a home for $300,000, we're talking about anywhere between $6,000 to $15,000 on a mortgage. So they promote this idea of the no points mortgage, that you don't have to pay any points, and points are viewed as this bad thing. But you are paying it one way or the other. There is a little sneaky rule that if you are a bank, if you are a credit union, if you are a lender, and defining by lender that if you get a loan that says Joe Blow lender, and the paperwork that you're going to sign says Joe Blow lender, they don't have to disclose how much you're getting paid in the back. Mortgage brokers like me, we are like, we have to disclose how much we get. And especially here in California, there is a form that you have to fill in how much the brokerage is going to get. So we have to disclose it, but lenders do not. So what I've seen they do is they hide their compensation within the points, because points really means that you're buying down the rate, means that you're paying the lender in order to get a lower rate. That should be a completely separate line. It should be called discounted points. But the law allows them to merge and mix their compensation in between in order to hide it, in order to say, oh, well, look, this loan is not really costing you. But that is not true. So the problem with loans is not that they are bad or they are good, it's that they are undisclosed. They're not explained. I take the trouble of explaining every single line of the loan estimate, every single line of the closing disclosure. I have a Zoom call with my clients for 1 or 2 hours to review all of the paperwork of the loan before the notary. Here in California, the notary shows up, then you sign it, and then he funds. In Florida, I understand that you can sign it right away at the closing office, the settlement office, the title company, and you're done.
Yeah.
Here it's not like that. So I explain every single document, and that is when it's not done. If you're going to get a loan, just make sure your loan officer or broker or whoever really explains it line by line. Loans are and remember this, loans are expensive, and you are always paying for it. You're either paying it up front, and you can see it in black and white, or you can pay it in the back. What does it mean in the back? It means that you're paying a slightly higher rate in order for the financial institution to compensate the people that originated the loan. And there is no escaping that. No matter what the person says, no, don't worry, there is no point, there is no this. The only people that you can believe about that is credit unions. Why? Because credit unions are a sort of a non-profit organization, not a non-profit, but they are a profit for their members.
Right.
And therefore you can, if they say, this is no point loans, I will believe them.
Yeah, they're credit unions are member owned. And so I've had situations. So credit unions are some of the toughest to negotiate with. So if you have a credit card or something that you want to try to negotiate with them, they're some of the hardest to negotiate with in terms of they won't take a discount on what's owed because they say we're owned by the members. We're not owned by a bunch of shareholders and stockholders and whatnot. At the same time, they're some of the easiest to negotiate with because they have a lot more flexible terms. You go to a Bank of America, and they're really not going to do much for you. You go to a credit union, and they have ways we can, extend this out so you can pay it back over a longer period of time or whatever. So yeah, I was going to say credit unions are member owned versus, stockholder owned, stockholder driven. So I did want to give out your contact information here real quick. I've got your email address, which is alejandro@prosperitylending.us.
Or a quicker one or a simpler one would be info@prosperitylending.us. Some people may not know how to spell Alejandro, although thanks to Lady Gaga, I think that's changing. But info@prosperitylending.us. It's a simpler one.
Yeah, I'll put that in the notes. So if you didn't catch it, you can go to the notes. You can find Alejandro's information. I do want to talk about real quick. I want to talk about our second sponsor. And so for those of you that are longtime listeners, that's Sam Cohen with Attorneys First Insurance. And so Sam writes errors and omissions insurance or malpractice coverage for attorneys and title companies all over the country. Now, Sam is located here in Florida, so he's got a particular focus on Florida. I know he's got a particular focus on Texas. And so a great way to support the show would be to support Sam and Mark, our sponsor from the beginning. But you can give Sam a referral to an attorney or a new title company that is just starting up. He can write their E&O policy, their malpractice coverage. You can reach him at sam@attorneysfirst.com or www.attorneysfirst.com. But Alejandro, anything you wanted to add? Anything we didn't talk about?
I think we covered it all.
Good.
Thank you, Sean. It's been a pleasure talking to you, meeting you, and being on your show.
Yeah, thank you. I appreciate it. And this is an interesting topic, and one close to my heart, obviously, as a self-employed business owner, but one that we've never really tackled before on the show in terms of why is it so difficult for the self-employed to get mortgages. So I appreciate the conversation. Thank you very much for being on the show. I will wrap up this show like I wrap up all my others and hope that at the end of the month you have more money rather than at the end of the money you have more month. Thank you again to Alejandro Szita. I'll post his contact information and all the other information in the show notes. And I think that'll do it for this week's episode of the Crushing Debt Podcast, and we look forward to talking to you in next week's episode.
If you have questions that you think would make a great topic for a future episode, please email Sean or connect with us on social media. Sean Yesner and Yesner Law, PL, are Florida licensed attorneys. The information contained in this week's episode is not a substitute for legal advice. Your situation may differ, especially if you are located somewhere other than the state of Florida. If you have questions, please contact our office or contact a local attorney. Thank you for listening to this week's episode of the Crushing Debt Podcast.